Hey, good morning, everyone.
Good
Good
morning.
Good morning.
Good
Good morning.
morning. Good morning. How's everybody? Um, well, finally, Friday, and we just have, after today, we have only one day left, Monday, right? Monday next week, and then this term is over. So we are, okay, I'm sharing application now. So, wow. Uh, and we have to really move at the speed of the light. so so yesterday, uh, the I talked about the return risk ratio, and I talked about uh, why return risk ratio is very solidly logical, very solidly logical measure of efficiency. And I used, also I compared it to uh, gas mileage, right? If you remember, right? There's a reason why uh, we use gas mileage, and the reason is very straightforward and simple. Again, that thing. So I believe, where did I put the gas mileage? Here, somewhere here. Okay, yeah. And I also said, although in U.S. gas mileage is miles per gallon, in other words, output to input, right? Output to input ratio. In some other countries, they also use the inverse gas mileage. In other words, input to output, right? And in case like liters per kilometer, in case they use inverse uh, ratio, inverse gas mileage, then the lower the number, the better it is. So that brings us to uh, where is it? Coefficient of variation. Coefficient of variation, which is exactly the reciprocal of return risk ratio. So return risk ratio or mean variance, mean standard deviation ratio, in case of mean standard deviation ratio, the higher the number, the better it is. But in case of its reciprocal, the lower the number, the better it is. But you still arrive at the same conclusion. I mean, the ranking, in terms of ranking, right? Z will be uh, number one, X will be number two, Y will be number three. So basically, it's all, think about it. If you achieve the same, if you achieve the same goal with less input, that's more efficient. I mean, as a good example, after graduating from college, right? After graduating from college with bachelor's degree, let's say you graduated from CUNY school, or you graduated, otherwise, on the other end, you graduated from NYU, Stern, right? NYU Stern Business School, or Columbia. I mean, did, if you studied, finance, majored in finance at CUNY, of course, uh, from CUNY it would be Zicklin School, or Zicklin at Baruch, or maybe CCNY. I mean, it doesn't matter, but mostly, business school in CUNY. Uh, the preferred choice by the students is, Baruch's Zicklin school. But then think about the input. How much did it take? I mean, if you went to Stern NYU, it would have cost probably at least like $100,000 for I don't know $200,000 for bachelor's for 4 years. It would have cost like $50,000 a year. If you went to Baruch, probably $30,000 a year, or even less. Maybe 25,000 a year. Then it's just half the cost. And when you graduate and land a job, on average, on average, you will be doing the same type of work, and you will get pretty much your annual salary will be pretty much the same. I mean, I'm not saying NYU is just about NYU Stern is just about the same level as Baruch, but because of this efficiency, right? Cost efficiency, and so, and there can be individual differences. Some Stern graduates may end up with a better paying job, but as far as they end up with the same type of jobs that in Wall Street, becoming a trader or whatever, working for wealth management, basically, for the same type of jobs, the pay would be pretty much the same. So, and then, even if the pay is not the same, even if NYU Stern graduates get more, but if you then, think about it. If you take this, in output to input ratio, then, CUNY school comes out ahead, right? So that's the concept of, input output ratio. And then with the input output ratio, right, what I can do is, I can allocate the weight. Of course, I would allocate the most into Z, and then next into X, and then least into Y. But this can be, of course, this allocation, exact optimal allocation, the optimal allocation will be more, will be more sophisticated, right? And it will be through more sophisticated process. But that's something you will learn in Finance 300. But on this level, I just used mechanical, a mechanical method. I mean, it doesn't have to be exactly like this, as long as there's the most weight in Z and the least weight in Y. But the if I allocate it like this, and this is just mechanical way. How I did that is simple. Just to explain. First, we have three numbers, right? 1 through 3, right? So I sum, right? I sum those three numbers, right? Which is 6 then, right? And this is then the denominator of the weight, right? So then, and this was Y, X, and Z, right? So the weight in Z, the weight in X, weight in Y is then simply, 3 over 6, 2 over 6, 1 over 6, right? This is the denominator, right? So the highest weight goes to Z, right? That's why it was second high, the lowest, right? That's why it's just mechanical. It's just mechanical. I'm not saying this is the not optimal, not necessarily optimal. Just makes your job easier. It just allocates it in a decaying pattern. It allocates the weight in a decaying pattern. Decaying, meaning, like, right? Decaying pattern. Weight goes down in a decaying pattern, right? Weight in Z, weight in X, weight in Y, right? Goes down in decaying pattern. Nicely decaying pattern. Now, so I'm gonna there's a lot more to talk about, in terms of normal distribution, but we're gonna come back to this later because we don't have time. We gotta move on to the stock valuation. Okay, so next topic is stock valuation, and let me go to, do I have stock valuation? Yeah. Okay, I'm going to skip everything about the. I'm going to skip because in the original in the original lecture, and I used two. You can see I had two reading materials there. One of which is a PowerPoint file. So let me download this. No, I'm not gonna. Okay, I'm not gonna download that. But I used that. Mainly used that file to explain. But there were two parts in stock valuation. Two parts. One is institutional aspect. I should have. One is, institutional aspect. The other one is valuation aspect. I'm not going to talk about the institutional aspect. In other words, common stock, preferred stock, uh, uh, institutional aspect. I'm not going to talk about that because it's something you can just read up. Common stocks come with, voting rights, all that, IPO. It's something you can just read up. I'm going to go to the valuation aspect, right? So there are 4 valuation models. I mean, unlike unlike bond, in bond valuation models, there were, either it's just straightforward, either zero coupon bond or coupon bond. Zero coupon bond was a straightforward, single cash flow model, right? Discounting of, it's the present value of, single cash flow model. It's very straightforward. And then for coupon bond, it's, it's 2 parts, right? annuity, present value of annuity, and present value of single cash flow, right? And the sum of those two. But in stocks, the valuation models are, there are four. One, zero growth model. Two, constant growth model. Three, variable growth model. Variable growth model. And four, free cash flow model. Free cash flow. Okay. Now, first of all, something that is very often, that can be confusing to students is that the zero growth model and constant growth model go by different names, but also by different names, but that can be confusing. Why? Because zero growth model is also called constant dividend model. Or constant dividend model, or perpetuity model. Now, constant, because the name is constant dividend model, and the second model is constant growth model, just because of the word constant, some people say it's confusing, but it's not. They actually are two different, completely opposite. These two are completely opposite. Why? When we say growth, what does that mean? Growth of what? Growth of what? It's all about the growth of dividends, right? Growth of dividends. Now, if that means, the first model, in case of first model, dividend is not growing at all. It's always, if the dividend isn't growing at all, then that's why zero growth. Then dividend is constant all the time. That's why it's constant dividend. But then constant growth model means growth, dividend is growing, but at a constant rate. At a constant rate, that means at the same rate all the time. Okay, just like think about it, the compounding, the first, in a single cash flow compounding example, right? We get to the future value by multiplying the principal by 1 plus r raised to n, and that r is constant. I mean, even if n is 10 or 20 or 30, r remains r, right? It doesn't change. That's why you can raise it to 30, or you can raise it to n, right? Of course, then, in case of, interest rate, that's possible, because interest rate is, when you lock into a something like a CD contract, right? For 10 years. I mean, if there's a 10-year CD, there can be. It's just that the bank customers, right, the lenders, don't want to lock in their money into something, lock their money up into some contract, such a long-term contract. But it's possible. Interest rates would be constant. If you lock into a 10-year CD contract, interest rate will be constant. But in case of stocks, how can the return be constant? I mean, returns are supposed to be, actual returns are uneven, right? That's only natural. I mean, that's what you saw. did I saved that file? Where is that? Yeah, here, Apple. Come on. Yeah, it's open. It's open. Right? You saw that, right? The actual returns are uh, it's supposed to be, all uneven. So how can there be a, constant growth rate? Uh, and the growth rate and return, I I make distinction about the difference between, growth rate and return in the first topic already in ROI. Uh, Basically, return and growth rates have no difference. They are no different only under scenario one. Remember, scenario one, uh, when there is no
rent income.
yeah. In other words, you're right. Uh, yes. So that was EN. I'm
Yeah.
gonna give you yeah 0.5 for that contribution. Um, yes, when there is no incidental income, incidental cash flow, like rent or interest or dividends, right? Uh, when there is only just growth, the, the cash flow, the only cash flow is from capital gains or capital loss, then the growth rate and return are the same. But when there is additional income, right? Like the rent, interest, or dividends, uh, then we have to, and and also especially when there is like regular on regular basis, right? Not sporadically, on regular basis. Then um, the return is different from growth rate, right? And that return is called yield. Okay. Um, so question is then how can we have these these are growth rates basically. I mean, if there is no dividend, these are simply growth rates. But of course, we know it's not growth rate; it's return because uh, Apple paid uh, dividend, right? Quarterly, every quarter, Apple paid dividend. Of course, over the 40-year life of Apple, there was a time when Apple didn't pay dividend. Apple stopped paying dividends for about 10 years. That happened, between, 90, somewhere like mid 90s to mid 2000s, right? So like 95 through 2005 or somewhere around that, Apple halted, right, paying dividends for about a decade. Um, and that was a time when Apple was going through some difficult times and they needed to uh, grab every penny. Um, so, in other words, all of the EAT, earnings after taxes, were uh, plowed back plowed back into the company for growth. Okay, so they didn't. But anyway, the point is, um, so although in reality, constant growth rate is unrealistic, but the constant growth rate we are talking about here is geometric average, right? Think about it. We can find the geometric average, right, and use it as the constant growth rate. And in this case, this model is called Gordon growth model. Constant growth model is called Gordon growth model because, uh, okay, this may make look like I'm gonna have to. Okay, so what do I do? Okay. So this thing is called, and this is, geometric average, and it's called Gordon growth model. Gordon growth model, right? And then variable growth model assumes, because think about it, how can any company grow at a constant rate? I mean, uh, well, you can grow at a constant rate after a company has made, certain, milestone. In other words, a company's revenue, when the company grows to a certain status, mature status. I mean, not fully mature, but a certain strong status in the market, right, in the industry. Then the growth rate settles to a relatively, constant, uh, steady level. But at the beginning, growth rate usually, when company takes off, what I'm talking about is their product catches on with the gains popularity in the market and grows explosively. Early on, the growth is supposed to be explosive. So in other words, growth rate has several phases. High growth phase, relatively constant growth phase, constant and slower growth phase, and then flat zero growth phase, and declining negative growth phase. Um, this comes from industry life cycle theory. Industry life cycle. So that would be more realistic. So then, we use variable growth model. And then free cash flow model is the case when company doesn't pay any dividend. When company doesn't pay any dividend. I don't know if this looks like dividend. When company doesn't pay any dividend, right? What to do? How? What? How do we value it? Okay, and that's possible because now think about it. All valuation models depend on what? Growth of the dividend, growth rate of the dividend. In other words, all these valuation models are basically what they call dividend discount model, right? Dividend discount model. Dividend discount model. So if the company doesn't pay any dividend, then this cannot work, right? The company doesn't pay dividend, that cannot work. But that's possible because I've been telling you, dividend is not an obligation. They may or may not pay dividends, and they will, as I said, Apple. There was a period of almost a decade between 90 something and 2000 something, when Apple halted paying dividends. So if they don't pay dividends, Tesla didn't pay dividends in early days. I don't think Tesla is paying dividends even now, because all the growth companies, all the growth firms, fast-growing companies, don't pay dividends because they need to, plow back everything into growth. But if that's the case, how do we value? Uh, because they don't pay. Well, we use a free cash flow model. Okay, and also DDM, dividend discount model, is only a subset. And then, are there more? No, it's what I'm saying is it's just the subcategory of discounted cash flow model. Discounted cash flow, right? Think about it. Bond valuation model is basically discounted cash flow. Discounted cash flow model is basically, discounting present value, right? And so discounted cash flow model is more generic name, and dividend discount model is so subcategory of DCF. And think about it. Dividend is a kind of cash flow. Dividend is a cash flow, right? Dividend is a kind of cash flow, right? So now let's take we'll take a look at first zero growth model. Zero growth model formula is simply, right? I will use, V0 as the symbol for intrinsic value of the stock. Intrinsic value of the stock. And in first, zero growth model, the formula is dividend over R, simply. Okay. Now, this dividend doesn't have any time subscript because dividend is constant. So what kind of company would be the case of zero growth model? A company, a mature company, a fully mature company, right? Why? Because if a company is mature, what does that mean? Will this company grow? I mean, does this company have a fully mature company? Does it have great future growth potential?
No, because it's
No.
to the maximum.
Yeah. Who said that?
Yeah.
Oh, again. All right. So yeah, you have another 0.5. Yeah. Mature company means it's fully grown, meaning it has its market share has no room for growth. Its market share has no room for growth. I mean, it doesn't mean that it cannot, but unless they tap into a new, in other words, unless they tap into a new market segment or with a new product that hasn't, with an innovative product, right? I mean, if it just has, one good example is like Coca-Cola or Pepsi-Cola, right? Coke and Pepsi. They are mature companies. I mean, think about it. Geographically, is there anywhere in the world they haven't reached? As far as the geographic market is concerned, right? And their product is, for like 100 years, Coke, Pepsi, the carbonated soft drink. So think about it. The bottles of how many bottles of Coke do they sell per day globally? Even if there are how many people? I believe 2.1 billion people. I'm not sure. Uh, I guess China alone is 1.6 billion. Correct me if I'm wrong. Well, the entire world population is like 2 billion or 2.1 billion. And if everyone, the entire world population, drinks one bottle of Coke a day, right? Unless then their sales limit revenue, their revenue is capped at 2.1 billion bottles a year and a day per day. Of course, a year times 365. But that's the maximum. Of course, not everyone drinks Coke, so with give or take of some, give or take some. So only let's say 50% of the world population drinks one bottle of Coke a day. Then still then that means there is still room for growth, room for 100% growth, isn't it right? If only half the world population drinks Coke, uh, then for Coca-Cola there is still room for growth, and the growth will be 100% if everyone in the world drinks. But most let's say either that or everyone drinks Coke, everyone in the world, but not a bottle a day, right? Let's say everyone drinks only on average half a bottle on average, then that still presents room for growth, right? Room for growth. But currently, pretty much Coke and Pepsi they like share the global market share. Coke probably 60%, 70%, Pepsi 30%, or 60%, 40%, whatever. So they are, for market share, geographic market, uh, not very much room for growth, right? That's what mature company means. But uh, again, if they tap into, if they come up with a new product, something like, not just, Coke, not soft drink, but let's say regular soft drink, but let's say they come up with uh, something like energy and diet drink. Energy and diet drink. Usually, diet drink is has no calories, so you feel it lacks nutrient. You feel, but that's why it's diet. But then this is diet plus energy. I mean, it's so I wonder if it is possible, but so it's got 0 calorie, but still it gives you it's an energy booster. I don't know if it is possible. If there's something like that, right? Then this is a new market, new entire world population is a potential, uh, you know, potential for their growth, right? So again, mature companies uh, are not always mature companies because depending on the product, Coke and Pepsi, if you're talking about only Coke and Pepsi, they are mature. If they ever come up, and think about it, even the smartphone market is pretty much, uh, uh, shared by Galaxy and Apple. Of course, there's some, other, uh, uh, what's the Chinese phone, Huawei or whatever. Um, but pretty much the world, the global iPhone market is, uh, uh, occupied by, dominated by Apple and iPhone and Galaxy. So then, and almost everyone these days, almost everyone, probably the entire world population, right, except for some minors, some young children, uh, almost every teenager, every grown up, all carry have one at least one smartphone. So then, where's the room for growth? Is there room for growth? Uh, People, yes, of course, because they always launch a new product. New product means innovative product, right? It doesn't necessarily mean, I still use, Galaxy Note 8. I use Galaxy Note 8. I like it. I don't like to change it. uh, I'm happy with it. Um, it's not like I'm buying. When I have one phone, that's enough. I mean, some people may need two phones, but not everyone needs two phones. It's just one phone, right? One number. Some people need multiple numbers. I mean, then multiple phones. But in general, so if everyone has already, one smartphone, then the market is saturated. And it seems like unless the phone breaks down, I mean, the only reason I would change the phone is when the phone breaks down or the technology is no longer supported. My, operating system, whatever, uh, uh, Android operating system it is. I mean, if it is no longer supported, no longer updated, then I will have to change the phone, right? But until then, so uh, where's the room for growth? It seems like there's no room for growth, but that's why they come up with a new innovative models. I mean, there is a difference between new and novel. I mean, in French, uh, uh, the word new, there are two words for new. One is not nouveau. The other one is neuf. Nouveau means, English cognate is novel. But in English, novelty means something, something novelty, something exotic, um, something unusual. But, its meaning, nouveau means, innovative, something that is, innovative. Neuf, French word neuf means just new. I mean, if I buy a new phone, and if it is another Galaxy Note 8, it's just new. It's just brand new phone, not an innovative. I mean, if I buy Galaxy Z Z Fold, then that's a new innovative, right? So they always come up with, right? Innovative. Um, but think about it. If the world, if the companies like Coke and Pepsi, the dividend doesn't grow, so then this is how we value. Another case is it's called the perpetuity model. Also, remember, it's also called perpetuity model. What does that mean? Perpetuity is perpetual annuity. I mean, literally, it means perpetuity. It goes on forever. But it means perpetual annuity. So what's an annuity? Annuity has constant cash flow, constant payment, right? Regular payment at regular interval, right? So that's annuity. But perpetuity, but annuity has maturity. It stops at some point. But a perpetuity literally is perpetual. It doesn't stop. It's annuity that goes on forever. So if that's the case, what would be the case of that? Two things, as I said, completely mature company with zero growth potential, right? With zero growth potential. Second, preferred stock. Preferred stock is a perpetuity, and in the institutional on the institutional side of the main lecture, I explained what perpetuity is, what a preferred stock is, right? A preferred stock. So preferred stock pays fixed dividend, right? So the dividend doesn't change, right? Always the same. So depending on the, so think about it. If it is a fixed dividend, right, constant dividend, right, the valuation will change then depending on whether this goes up or this goes down, because dividend is constant. It doesn't change. The valuation will go down. The value will go down or go up depending on, right? And there's an inverse relationship, right? When the denominator goes up, the whole fraction goes down. Denominator goes down, the whole fraction goes up. Okay. The second, I'm going to talk about the golden growth model and talk about the examples in the second hour. The second model, constant growth model or golden growth model, it assumes, constant. It assumes constant growth rate, and the model is then dividend at time t+1. So next dividend, next quarter dividend. How do we know next quarter dividend? We can make a forecast, which is not a difficult thing. R minus G. Okay, and then how do we make a forecast? Well, we know what dividend at time t is. In other words, time t is time 0, right? Which is the current dividend. Current dividend means actually, previous quarter's dividend, right? You understand? Company can only pay out dividend once the current semester is over. So the dividend will be paid in the next semester. Next quarter. So fourth quarter 2021, fourth quarter 21 dividend will be paid in the middle of first quarter of 2022. So, and I've been telling you, January is the earnings season. During January, they all release the earnings report from the fourth quarter previous year. And then once the earnings report is released, then they pay out dividends. That happens in February. So usually that pattern repeats. Second quarter of this year, then April, they will release the first quarter earnings report, and the dividend for the first quarter will be paid out in around May, right? So we already have last quarter, previous quarter dividend, which is the dividend at time t. Think about it. Time 0 means beginning of the current quarter, but time 0 is end of the last quarter. So dividend at time 0 is actually the end of the last quarter dividend, right? So, and think about it. If we know this is growth rate of the dividends, right? And this is the average, geometric average. So if we know that, so if we just compound it once, then it will be dividend at time t+1. We can make a forecast like that. So R minus G. Sometimes, instead of R, right, you understand, they can use, notation K. And I've been telling you, K is what? A cost of capital, right? K is the symbol for cost of capital. So then you might wonder, oh, wasn't cost of capital interest rate? Yes and no, because cost of capital, only cost of debt. Cost of capital has uh, three classifications. One, cost of debt. Then there's interest rate, cost of debt. There is cost of preferred stock, which is the return, right, to uh, a preferred stock, right? And cost of equity, right? So return to common stock, right? So the notation K being used here, right? That, of course, means either cost of equity or cost of preferred stock, depending on, right, the context, right? So in the zero growth model, it's the cost of preferred stock. This is the and in the golden growth model, it's cost of uh, uh, return to common stock, right? All right, with these two, then we're gonna do. It's 12:56, so it's about a good time to take a break. So let's take a 10-minute break, and when we come back, we'll do the examples. Okay. So let's take a 10-minute break. 10 minutes. All right, we're back. We're back. So we're gonna let's do the examples first. It may not be the same example here, but okay, I don't know where. Okay, this one doesn't have, but it's not a big deal. Um, yeah, stock valuation. No, where did I? I'll simply open this one. Okay, so okay, here. Chuck Swimmer estimates that the dividend of Denim Company, an established textile producer, is expected to remain constant at $3 per share indefinitely. Now, there are clues, there are clues everywhere. There are clues. First of all, um, this company, right, Denim Company, it says the problem describes it as an established textile producer. Established, that means this is most likely a mature company. And it says it's expected to remain constant. It says remain constant, constant, zero growth, right? Zero growth, constant dividend, zero growth. Then, well, all you need to do is if the required return, right? Um, required return, cost of equity, right, is 15%, the discount rate, right? The stock's value, then $3 over 15% will come to $20. And once again, this is the intrinsic value, or rational price, or fair value, right? They all mean the same thing: intrinsic value, fair value, a rational price. Um, Again, then the market price may fluctuate around it. Sometimes it's higher, sometimes lower. Now, which is not a difficult thing. Next example. Lamar Company, a small cosmetics company, paid the following per share dividends. Lamar's required return is 15%. And it says a small company, um, and all these adjectives like established, mature, small, these adjectives, do you think it's just, you think it's meaningless part of the verbiage? I mean, of course, the true meaning behind it is that if a company is small, it has a lot of room to grow, right? Think about it. Although it will have to face a fierce competition, because the big players, right? Big players in the market will try to kill this off. But as long as it has its own niche, right? A small company has its own niche. then it has room for growth. Now, and then eventually it will be, but still the big players will try to kill it off, because think about it, 1%, 1% market share, 1% more market share this company brings in, 1% more market share this company brings in is actually 1% market share they take away from the other players, the other big players in the market, right? And little by little, if this company takes away 5%, 10%, then big players won't let it go on. So they would rather they would rather try to kill it off before it takes, while it's still small. Now, one good example. Now think about it. How many of you remember BlackBerry? How many of you remember BlackBerry?
I do.
Yeah, who was that?
Yeah, it's Leslie.
Leslie.
BlackBerry
Leslie.
phones. Yeah.
Yeah, BlackBerry, right? Even about but BlackBerry. Even about a decade ago, BlackBerry was still had a solid market share, but BlackBerry was terminated, I think, a couple of years ago. The last model, I mean, but think about it. In the age of smartphones with touch screen, BlackBerry didn't have touch screen, but it was just keypad, but still it had its own market niche, because in the corporate sector there was a demand for this keypad BlackBerry phone. I think it was probably because some people found it more, I don't know, for corporate purpose. It was probably, it did the job. It was sturdy, right? It was sturdy, and it did all the it satisfied all the requirements for corporate purpose. But so but then it finally, BlackBerry still had its niche, but finally, gave in. Finally gave in. But anyway, this small company paid these dividends over the last how many years? 1, 2, 3, 4, 5, 6 years. Paid these dividends as of the end of the year, right? As of the end of the year. So what does this mean? This company has, we know it has growing dividends, right? Growing dividends, and the growth rate is uneven. Of course, the growth rate is uneven, but it's not like a drastic growth, fast growth. So although it is uneven, it's like 5% from here, in the first year, 5%. How much would this be? I don't know, but growth rate would not be drastically, different from year to year. It would be somewhere, it would be reverting to some mean. So this is a typical example of golden growth model. So we find it says, here the solution shows 0.07, 7% growth rate. How did they get it? It is geometric growth rate, geometric return. So we know what to do. We know how these are prices, not growth rates. So then we already know. Yeah. the growth rate is future value over present value over 1 raised to 1 minus, or 1 over n minus 1. And then we know 2012, they paid, what was the earliest? 2012, $1.40. Beginning 2007, $1. So all you need to do is, we know what to do, right? All you need to do is, where is that thing? Whiteboard. $1.40, right? Over $1 raised to 1 over 6 minus 1. And if you do that, it's just the ratio is 1.4. I mean, we don't even need 1.4 divided by 1. It's just 1.4. We don't even need a calculator. All we need to do is then, the ratio is here. 1.4 raised to 1 over 6, close parenthesis, minus 1. Oh, actually 5 years. Why? Actually 5 years. All right. Let's go back there. It's actually 5 years. Why? Because from the end of 2007 to the end of 2012. So 1 year, 2 years, 3 years, 4 years, 5 years, right? I made a mistake there. And again, 1.4 raised to 1 over 5, close parenthesis, minus 1. So to be exact, it's 6.96%. 6.96%, right? And the required return is required return is 15%. So we know, okay, it's 1 over 5. And this comes to 6.96%. So plugging it into a golden growth model, first of all, the value of this stock at time 0 now, right, at present is, what was the last dividend? It was $1.40. But it will grow by 1 times 1.069, because 1 plus growth rate, right, over 15% is required return, minus 0.0696, which is almost, and it will come to whatever it comes to, right? My calculation, I mean, to be exact, it would be slightly, it will be close to this, but 18.75, right? It will be something like 8.7 something, right? So this is, what a golden growth model is, and most of the, and in some courses, especially in accounting, they only, in accounting, sometimes accounting, they try to encroach into finance, thinking that they know finance. But accounting, yeah, I mean, if you have like PhD in accounting, advanced degree, at that level, they would fully understand finance. But if they don't have PhD, they are only, because accounting, the tendency of accounting is not about thinking, but trying to minimize thinking, right? It's always like something for dummies. What is something for dummies? Something for dummies is oh, this is the shortcut. This without understanding why and how it is done that way. They just say oh, rule of 70, rule of 78. You divide it by rule of 72. 72 divided by whatever, and then that's the number of years. I mean, why 72? Why 72? Why out of blue? Why? They never talk about it. But accounting is just like that. They never tell you why and how, but just this is the trick. But if it is like that, everything is a trick. Everything is a trick. Without knowing the reasoning behind it, without understanding the rationale behind it. Why we do it that way? That's what's important, right? So here, and why do we do it this way? Now that's what I'm going to talk about here. Think about it. The formula is provided, and this is only the end result. This is only the end result, right? This is only the end result. But how did they come up with that formula? So if we go back to the nits and grits, the beginning, whole beginning. Think about it. A stock's value today is the discounted present value of all the future cash flows. So then think about it. Well, there will be dividend at time 1, dividend at time 2, dividend at time 3, and so on, right? They all need to be discounted. And if it goes to the nth, there will be a final stock price, Pn. But then think about it. Does stock have any, what is N for stock? What is that timeline? What is N? In other words, let me rewrite here. So basically, the basic concept is basically discounted cash flow. Dividend at time 1 plus R plus dividend at time 2, 1 plus R squared plus that ellipsis. That's called ellipsis. That. Plus then dividend at n minus 1, right? If n is the end of the timeline, there will be n minus 1, right? Of course. And then over 1 plus R raised to n minus 1 plus, and at the end, just like, think about it, just like the bond timeline, right? And we will have dividend at time n, and then 1 plus R raised to n. And then finally, there will be the final value of the stock, or final, not final, but price of the stock at time n, right? price of the stock at time n, which should be discounted, of course, by 1 plus r raised to n, right? But then our next question is, what is n? What is n for stock? Does the stock have any finite timeline? Anyone?
Infinity.
Say that again.
Infinity.
Everything. Okay, it's all muffled. Was it only one person? Did I hear only one voice, or there were multiple voices? Did I hear only one voice?
Infinity.
Yes, but was it only you? Is it En?
Yeah, just
And
me.
was it only your voice, or was there somebody else's voice too? Because it sounds all muffled to me.
I think it's just me.
Okay, it was so muffled. All right, En, you get another 0.5. Yeah, you're right. The timeline, I mean, there is no end to the stock's timeline, because stock's timeline is infinite. Why? Because the stock will go on as long as the company goes on, right? Until the company closes down and goes out of business, the stock will go on. So assuming that, who knows, BlackBerry had a good time. I mean, they had good years. Almost 2 decades, but then, they ended. I don't know if it's a Canadian company. BlackBerry was actually made by a Canadian company, I guess. RIM or something like that. RIM, Research in Motion. That was the name of the company. That's why RIM, BlackBerry. I don't know if that company still exists. If they do, although BlackBerry, the phone is gone, they must still be going on, because, why? They cannot simply, there are shareholders. Shareholders do not want to close down the company. I mean, what did I say? A company is a vessel, right? Didn't I say a company is a vessel to funnel the profits to the shareholders? So even if they terminated the model, BlackBerry, right, the phone, they may be still making parts for, or developing software for other applications. It doesn't have to be only mobile phone. It could be other mobile equipment or whatever. BlackBerry must be going on. But think about it. Apple has 40 years of history and is still going strong. Samsung, and think about it. They won't go out of business until the world is doomed. So that means this n is actually infinity, right? It can go on infinitely. Then think about it. If n is infinity, all these n's turn into infinity. It's infinity minus 1, infinity minus 1. Now think about it. Infinity minus 1. Think about it. What is this going to be? What is this going to be? Now, value of the stock at infinite time.
Infinity.
No. Value of the stock at infinite time horizon. Will it be infinity? No. This number, this will be infinity. One, right? This will be infinity. Why? Because any number greater than 1, any number that's greater than 1, right, when you raise it to infinity, if you think about it, if you raise 1 to infinity, it will still be 1. 1 times 1 times 1 times. But even if it is slightly greater than 1, even if it is slightly greater than 1, I mean, so 1 plus r, which is, any number that is 1 plus r will be, even even infinitesimally greater than 1. Infinitesimal means very small, like 1.000001. Even that, if you raise that to infinity, it will become an infinite number. But the stock price will be some finite number. It will just be a finite number. Okay? Finite number means even $1 million is finite number. $1 billion is finite number. But compared to infinity, finite number is, even 1 billion is still a small number compared to infinity. But the stock price won't go to like $1 billion or $1 billion. Why? Think about it. Stock price, for two reasons. One, you've seen, right, as we reviewed, Apple's, stock price over the last, 40 years, you've seen several stock splits, right? And I told you when and even after that, in around 2014, there was a split, and the stock price was like, 660, and they had a 7-to-1 split. So after the split, it was like $89. But if you had a 1 share, it's now 7 shares, right? So the total value, your total amount invested, held in Apple, is still the same. But then even after that, 2018, I think they had a split. Even in 2020, they had a split. I think 2020, like August, they had a split. But why do they split? Why do they split? Do you remember municipal bond, right?
Yeah.
It looks like I'm only talking to myself. So let's see. How many people are there? Only 6 people. Angel, are you there, Angel? Darlene, are you there, Darlene? Leslyn, are you there, Leslyn? You just
I'm here,
I'm here.
Professor.
Professor.
Okay, good. Okay, why was there a delay in response, huh? Randy, are you there? Randy, are you there? Stephen, are you there? Stephen, are you there? Okay, so some people are not there. But do you remember municipal bond? Right?
Yes.
What's the face value of the municipal bond? Anyone? Face value of the municipal bond?
5,000.
5,000. Okay, who said it first? I heard 2 voices.
Me. Only me.
Oh, that was you? Only one? Sometimes, was it echo? It sounded like 2 voices. Yeah, 5,000. Face value of the municipal bond is 5,000. But I told you, it's mainly institutional investors that put money in the municipal bond, although the upside, the benefit of municipal bond is the
Tax-free?
yeah, tax exemption, right? Tax exemption. Mostly, it's only the institutional. Why? Individual investors generally don't, invest in municipal. Why? Because it's burdensome, right? You have to I mean, if you have $5,000, if you put into a treasury or corporate bond, you can buy about five. You can buy about five. But if you put into the municipal bond, you can buy only one. But then, what's the problem there? What's the difference? The difference is, suppose you need, like $2,000 urgently, right? If you had five corporate bonds, right? Each, you had, you put $5,000 into a corporate bond, so there will be at least five bonds. You can cash out only two. You can cash out only two, and easily, easily get, 2,000, and you can use 2,000, but still keep 3,000 in the bond, and still continue to earn. If the return was 10%, still continue to earn 10% on the bond. But if it is, in case of municipal bond, this cannot. You cannot do this. You cannot cash out conveniently $2,000. Just to cash out $2,000, then you'll have to sell the entire, the whole bond. You'll have to sell it. And then, just for 2,000, the remaining 3,000 will lose the opportunity to earn 5% interest on it. So then, so this is the rationale. Think about it. If the price is too high, it becomes less marketable because people find it less easily. People find it less liquidable. You cannot easily liquidate it. I mean, only it's less convenient, right? If the face value is too large, I mean, think about it. Amazon is about 2,000 something. Amazon is only about 2,000 something. 2,000, let's say 2,500. But actually, that doesn't mean Amazon has higher return than Apple. That doesn't mean Amazon is a better stock. I mean, both Apple and Amazon, they are like, Amazon has already reached $2 trillion. Maybe it has reached three. Apple has also touched on $3 trillion market capitalization. But Apple is about 150. Amazon is like 2,500. What does that mean? There are fewer shares of Amazon outstanding. In other words, if the denominator is smaller, then the fraction is bigger, right? There are more shares outstanding in Apple. And if I had $5,000, I can buy, if Apple is $100, I can buy 500 shares. But with Amazon, I can buy only 20 shares. Which one is more attractive to me? If, as long as the return is pretty much the same, risk is, standard deviation is pretty much the same, which one is more attractive to me? Apple would be more attractive to me. And Apple has, and also Apple wins out in terms of, also the return. And simply, why is it more attractive to me? Simply because if I have 500 shares in Apple, and if I want to liquidate, 100, I can easily do that, and still have, still keep 400 in, or I mean, think about it. If I have only $2,500, I can buy only one share of Amazon, but I can buy, 25 of Apple. Make sense? And then I can easily liquidate. I mean, if I need, $1,000 urgently, I can only sell 10 shares of Apple, still keep 15 shares in Apple, right? Still, earn the dividends and, interest, dividends and the capital gains. But if it is in case of Amazon, I have to sell that one share I have. This is the reason the stocks split, right? To make it more manageable, to make it more marketable. And from the investor's perspective, it is more liquidable and more manageable, right? Second reason, business cycle, boom and bust, boom and bust. Price goes up during the boom, price goes down during the bust, goes up, goes down, goes up, goes down. Yeah, there will be an upward trend. So probably 100 years later, or even a million years later, if Apple is still around a million years later, because of this boom and bust, boom and bust, boom and bust, although there will be an upward trend in price, but the price will still be within, price won't be an infinitely large amount. It won't be an infinitely large number. It will still be a finite number, right? Because of the stock split and the business cycle, right? Then think about it. A finite number. I've been telling you, no matter how big, even a billion is nothing compared to an infinity. So you divide even a billion or trillion by an infinity, what should it be? Huh? You divide a finite number by an infinitely large number, by an infinity, what should it be? This is just a logical reasoning. Anybody? If you
0,
divide,
0.
Oh, okay, was it Yang again?
Yeah.
Only one person is always answering. What about the other people? Other people are not interested in earning extra points, huh? This isn't even math. This is just a logical thinking, logical reasoning. Anybody can logically think that, oh, you divide any number by infinity, no matter how big the number may be, compared to infinity, it is insignificant. It will become close to zero, not exactly zero, close to zero, right? Close to zero. If it is close to zero, this term doesn't affect our valuation. It drops out. It drops out. Therefore, then it becomes only the discounted, literally dividend discount model. It becomes dividend discount model. And then how does that reduce to that, how does that reduce to this? Now think about it. So if we assume constant growth model, right? Constant growth model, then the whole thing, there will be no distinction between dividend 1, dividend 2, dividend 3. They will be all just dividend because it's the same number, right? It will be the same number. That ellipsis, right? And then dividend n minus 1 over 1 plus r raised to n minus 1. My handwriting, I'm writing on a screen that is standing up vertically. It's hard to write well. Please, bear with me. Please bear with my handwriting. Finally, and then dividend. Oh, okay. I'm sorry. This one, n minus 1. There was no need for that distinction. But at the bottom, of course. And here, okay, yeah. And you can all follow this. Let's call this equation 1. Let's call this equation 1. Okay. And then we're going to to equation 1, we're going to multiply we're going to do this, multiply y. Equation 1, we're going to multiply that by 1 plus r. Okay, and if we do that, that's going to be the right-hand side. Why isn't it moving? Okay. You remember the left-hand side is V0, right? Price of the bond, price of the stock at time 0. Then the left-hand side will be 1 plus r. When you do this, you have to do it to the both sides. 1 plus r times V0. And then this will be dividend. This will be just dividend because you know, this is what the economists, this is how the economists think. Economists, the difference between economists and accountants is that economists always want to, economists have to prove it. Like the mathematicians, they have to prove it. And they have to show the whole, they have to confirm, verify the whole process, why, the whole process of why and how. Accountants don't care. They just memorize the tricks, right? And then, you know, without understanding why, of course, I said, you know, if you're a PhD in accounting, you would, of course, appear on a doctoral level, you have to have the reasoning, the logical reasoning. Without the logical reasoning, right, nothing can be justified. So multiply the whole right-hand side by 1 plus r. This term, the first term will be only dividend, right? Of course, because it cancels out. You multiply 1 plus r to multiply 1 plus r to this. Think about it. Times 1 plus r. It will cancel out, right? It will cancel out. So it will be dividend. The second one, the second term becomes dividend over 1 plus r. And everything will lose. All the denominators will lose. So if you think, you know, oh, why do we do that? It's boring. Well, look, if you are trying to learn and improve your brain's ability, to do, you know, logical reasoning, right? You should be, you know, comfortable with something like this. So the this one becomes, you know, dividend over 1 plus r raised to 1 minus 2. And that's how your brain gets smarter, right? Being able to do the logical reasoning, the ability to do the logical reasoning, that's what makes your brain smarter, right? So you do, you know, this one becomes n minus 1. And let's call this equation 2. Let's call this equation 2. And now let's, then what's next? Let's subtract from equation 2, let's subtract equation 1. What's the time? Oh, God. And then what's going to happen? So everything if you subtract, 1 is being subtracted from equation 2, then think about it. The left-hand side, what happens to the left-hand side? And the left-hand side, what happens is 1 plus r v0 times v0 minus v0, right? That's what happens to the left-hand side, because the left-hand side of the equation 1 is v0, right? And then in the right-hand side, then, what's going to happen? The right-hand side, this will cancel out. This term, this and this will cancel out, right? And this one will cancel out with, whatever is dividend over 1 plus r. Everything will cancel out. This one will cancel out with its matching counterpart, because they are all negatives, because you are subtracting, right? They are all negatives. And this one, they will cancel out. So you are left with what? You're left with remember, you're left with this one remains, right? In the left-hand side, you have dividend. Dividend and minus, remember this one remains, and the sign is negative because you're subtracting it. You have minus dividend over 1 plus minus dividend over 1 plus r to the n. Okay? But actually, think about it. Because this one is, what? Actually, if you think about it, whatever it is, this one is also practically zero. It's practically zero, right? Isn't it right? So this one affect, this one doesn't affect our equation, right? And then the right-hand side, we have that left. And left-hand side, then we redistribute, right? We redistribute, right? So it's going to be V0 plus R times V0 minus V0 in the left-hand side. On the right-hand side, just dividend. And what happens to these two? They cancel out. So finally, you have only R times V0 left in the left-hand side. On the right-hand side, just dividend, right? And what is V0? Then V0 is Z equals X times Y. So X is Z divided by Y. Dividend over R. Okay? Hence this formula. Okay? It just doesn't, accounting, they never tell you this. Even in other finance courses, no finance textbooks, I don't know in what school they teach you this. Maybe, you can find it somehow, maybe in MIT. But nowhere else. They just give you this and memorize. Well, I don't like that. I've been telling you, our memory, uh, if you memorize every day, yeah, you can memorize it. Maybe it will be it will stick to you for the rest of your life. But you have so many things to memorize. After the semester, it will be gone. You can't. So there's a limit to clearly. And it's a dumb thing to just do it by rote memory. Rote memory is a dumb thing. If you know how it is derived, then and if you can do that, you will never need to memorize it, and you will always know it. You can always derive it. Okay. All righty. So it's 2:01. Let's take a 10-minute break because my throat needs a break. Okay. All righty. So let's take a 10-minute. All right, we're back. We're back now. So, we have only it's 20 minutes, right? We have only 20 minutes. So now this time I want to. You might think, oh, I don't want to bother. I just want to, just get over with it. I think that would be mostly your mindset. Uh, but as long as we are doing this, because it's me, I always, have. Now, think about it. I was always wondering why, as a student, I always wondered why is it this form? I mean, where did it come from? Where did it come from? I mean, uh, the the beginning of the valuation formula is always, like discounted cash flow. I mean, it should look like this, but how did it ever turn into this? Right? That was my question, and I couldn't sleep over it. I couldn't sleep over it, right? Until I knew, because I didn't want to just, memorize this without the connection between the initial form and the final form. And only as a graduate student, and I only started to study economics and finance as a graduate student. As an undergrad, I was just liberal arts. But as a grad student, I eventually I worked at it. I eventually discovered it. Right? And then also, why is Golden Growth Model? Why does Golden Growth Model look suddenly like this? I mean, why does it look like this? Dividend at time t plus 1, r minus g. Why does it look like this? I mean, dividend, why only dividend d plus 1? I mean, Golden Growth Model, shouldn't it also start all from this? Right? And maybe, and dividend 1, dividend 2 is, dividend 1 plus, dividend 1 times 1 plus g. Dividend 3 is dividend 2 times 1 plus g. So dividend 1 times, 1 plus g raised to n, right? Something like that. But then why only, I mean, if it goes to the infinite future, why only dividend at time t plus 1? Why not, t plus n? Huh? Why? And why subtract growth rate from there? Rather, shouldn't we add growth rate? Shouldn't we add, So there were so many questions in my mind as, as a graduate student. And, but I answered it all myself, So I want to show you how that was done. So the derivation, the steps, derivation of Golden Growth Model. I mean, this was the, this thing was the, derivation of zero growth model, right? But then what's the steps of derivation for Golden Growth Model, right? Derivation of Golden Growth Model. I will use my slide to explain that. So here, well, I should find it. It was somewhere here. I put it somewhere here. I don't know why I put it here. It's only because there was a space to put it. Yeah, here. How is the golden growth? So remember, I've been making distinction between growth rate and the return. So here, K is the return. K is the same thing, right, as required return. K is cost of equity. Now think about it. If you buy the stock today at this price, PT, and if there's at time t plus 1 in the future, right, it will grow to PT plus 1 and DT plus 1. In other words, PT plus 1 is the price of the stock at time t plus 1. And this is the dividend at time t plus 1. Right? Dividend paid at time t plus 1. And think about it. That's what the return is. I mean, the difference between return and growth rate is if it is not K, but just the growth rate, then PT compounded by growth rate, right, 1 plus G, will only become PT plus 1, right? It will only be PT plus 1, only capital gains. But there won't be only capital gains. There will be also additional income, which is dividend. So that's why it's return, right? So then if I solve this for 1 plus K, right? Of course, I divide both sides by PT, right? And then think about it. PT plus 1 is what? PT plus 1 is PT times 1 plus growth rate. I mean, that's the difference between growth rate and return, right? PT plus 1 is PT times 1 plus G, right? It's just the growth rate. And then plus DT plus 1. And then in the left-hand side, we can break it up. We can break it up. In other words, the left-hand side will become P. The left-hand side becomes, right, PT, just PT plus G plus DT, right? PT, what did I do? PT, PT times, okay. PT times P. PT times G, right? Right? Why? Remember, this was basically, PT times 1 plus G, right? So when you open the parenthesis, right, if you read this previous copy, then this whole thing becomes what? You can break it up like PT over PT plus PT times G over PT plus DT plus 1, I'm sorry, DT plus 1 PT, right? This becomes 1. And this becomes G, right? It's still this. Oh, what happened? Right? And then see why it is like that. And in the right-hand side, 1 plus K. So then isolating only DT plus isolating only this, move all this to the right-hand side. 1 and 1 will cancel out. G will become, G will be negative G because you're, moving to the other side of the equation. And then if we solve this for PT, because, we want to know what's the price of, the stock at time T, this is Z over Y equals X. So if you want to know Z divided by X equals Y, so if you want to know what X is, then Z divided by Y. So dt plus 1 over K minus G. K is R, right? And voila, there is that Gordon growth model. Okay, this is how I derive the Gordon growth model. I mean, this is like reverse engineering because no textbook explains this. Professor Gordon, who devised this model in 1950s, late 1950s, he devised this model, and he was probably in his 30s in 1950s. So he died actually. He passed away. I don't know if he was, he passed away in 1990s. If he was in his late 30s in 1950s, then 40 years later, 50 years later, 1950s, 1990s, like 40 years later, he would be in his, 80s, so he passed away in 1990s. And I never got but you can look up, I later looked up, I Googled up how Professor Gordon derived the model. I don't know if it is Gordon's original model or someone else's, interpretation. Gordon's original paper or, someone else's interpretation. It was slightly different. How it was derived was slightly different. But this is my own interpretation, my own way, my own interpretation of Gordon growth model. Okay? But it, in a nutshell, it perfectly sums it up. Without making it more complex, right? How that long formula, how that, in other words, the original, right? This is the basic concept of, discounted cash flow model, this dividend discount model. How does that transform into, right? That answered my question, right? How does it, because my question was, why R minus G? Why? Where did that, minus G come from? G, it makes, I know it's growth rate. Why do we subtract growth rate from the, required return? Because of the growth rate, shouldn't we actually augment, right? Shouldn't we augment the required return? Shouldn't we ask for higher required return? But no matter how you try to conceptualize, verbally, this philosophizing is philosophizing is verbal, wordy philosophizing is all just, nothing but BS. Why? Because it doesn't answer anything. Only math can answer it. Only math can answer it. And of course, you have to have a logical reasoning behind it. Without logical reasoning, there's no basis for math. Right? Alrighty, so that makes it today's, that makes today's class, because we have like 4 minutes left, but we cannot do more. The remaining models are what? Variable growth model, and free cash flow model. We will need to talk about this on Monday. And together with this on Monday, we'll have to finish up the remaining part 2 of the risk and return. Okay. All righty. Any questions so far? Any questions? Any questions?
The final is on Monday or Sunday?
Say it again. Final? The
Um,
final is
yeah.
Monday. Of course, Monday. Then look. Wasn't the didn't you get the email? Wasn't it supposed to be? I thought it was sent out already. Final. It was posted already today. Posted already today. Didn't you get it?
Yes.
Okay. It's due Monday. Okay. All right. Any other questions? Any other questions? Okay, I would take it as no. Are you guys there? By the way, are you guys there?
Yes.
Okay, Stephen. I was okay. I was calling your name before.
I'm not sure what happened there. I'm sorry.
So because everybody is very quiet, I kind of I have to verify every time if people are paying attention. All right. So if there is no more, Darlene, you have a question?
Yes.
Yeah. Go ahead.
I'm looking online right now. I see quiz number 2, but I don't see the final.
No. It says it will become only the instruction went out today.
Oh.
It will become available from Saturday, tomorrow, right?
Mm-hmm.
3-day window. 3-day window. If it is due Monday, 3-day window starts from Saturday. Okay.
And quiz number 2 is due tomorrow at 12 a.m. or 11:59.
Yeah. Tomorrow, 11:59. 11:59. Tomorrow. 11:59 tomorrow. Okay. 11:59 p.m. tomorrow. Where's quiz 2? All right. Any other questions? Any other? Okay. I would take it as no. All right, then. Have a great afternoon, everyone, and good luck with your quiz 2 and final. I mean, good luck for final is too soon. But anyway. Have a great afternoon and have a great weekend. I will see you guys on the last day, Monday, right? At 12. All right.
Bye,
All right.
Professor.
All right. Take care, Leslie, and take care, darling. And I will stop sharing and stop recording and sign out.